Part 1. The dollar is a system, not a currency. If the US dollar is supposedly collapsing, why does the world still rush into dollars every time a crisis hits? The answer is simple but uncomfortable. The dollar is not just money. It is the operating system of global finance. Most people think of the dollar as cash issued by the Federal Reserve, or numbers inside a US bank account. In reality, that is only a small fraction of the story. The US dollar functions as the primary funding currency of the global system. It is the main unit for trade settlement, the dominant collateral in financial markets, and the backbone of global debt. Energy trade is priced in dollars. Shipping contracts are settled in dollars. Emerging market debt is largely denominated in dollars. Even non-US banks borrow and lend in dollars to finance global commerce. This means the dollar is embedded deeply into how the world actually functions, not just how currencies are quoted on a screen. What many people miss is this: most dollars do not sit inside the United States. They circulate globally through international banks, offshore markets, shadow banking systems, and cross-border credit networks. This is what we call the global dollar system. The Eurodollar market, dollar repo markets, FX swap markets, and offshore credit channels all create and distribute dollar liquidity outside US borders. These dollars are not printed bills. They are balance sheet dollars created through lending, leverage, and financial intermediation. And this is where the confusion begins. When markets talk about a strong dollar or a weak dollar, most people assume it is about exchange rates or political headlines. But professional markets are reacting to something far more important: access to dollar funding. When dollar funding is abundant, risk assets rise, credit spreads tighten, and global markets breathe easier. When dollar funding becomes scarce, everything feels the pressure at once. Emerging markets struggle to refinance debt. Global banks reduce lending. Risk assets sell off regardless of fundamentals. This is why the dollar often strengthens during crises, even when the crisis originates in the United States itself. It is not because the US economy is suddenly strong. It is because the world needs dollars to survive. In moments of stress, the demand for dollar liquidity overwhelms everything else. The Federal Reserve understands this reality better than most investors. This is why, during major crises, the Fed opens dollar swap lines with foreign central banks, not as charity but as a necessity to stabilize the global system. Without these dollar backstops, global trade, credit markets, and financial plumbing begin to freeze. So when you hear claims that the dollar is dying, ask a better question. Has the global system found a replacement for dollar funding, dollar collateral, and dollar settlement at scale? So far, the answer remains no. The dollar's power does not come from confidence alone. It comes from structural dependency. And understanding that dependency leads to the next question. If the dollar is a system built on liquidity and funding access, who controls the flow and how is it managed? That is where the real signals begin. Part 2. Eurodollars and the illusion of easy money. The Federal Reserve does not control most of the dollars in the world. Most global dollars are created outside the United States through bank lending and credit creation. This offshore dollar network is known as the Eurodollar system. Eurodollars are not physical cash. They are dollar-denominated liabilities created by banks operating outside direct Federal Reserve jurisdiction. These dollars exist on balance sheets, not in vaults. And this structure explains many of the market's biggest misunderstandings. Because the Federal Reserve does not directly control the Eurodollar system, global dollar liquidity can tighten even when the Fed does not raise interest rates. The dollar can become scarce even when financial conditions appear calm on the surface. This is why markets sometimes break without warning. Banks may pull back from lending. FX swap costs may rise. Repo markets may show signs of stress. But none of this is visible if you only look at policy rates or headline inflation. Many traders rely on the DXY index to judge dollar conditions. But DXY only measures the dollar's value against a basket of other major currencies. It does not measure dollar availability. A falling DXY does not guarantee easier liquidity. Dollar funding stress can still build quietly beneath the surface, even while the dollar weakens on an exchange rate basis. This is one of the most dangerous illusions in global markets, because when dollar funding tightens, the problem is not price. It is access. Emerging markets feel this first. Dollar-denominated debt becomes harder to roll over. Local currencies weaken, capital flows reverse, but the pressure does not stay contained. Global banks begin to reduce leverage. Risk premiums rise. Liquidity disappears from markets that once seemed stable. All of this can happen without a single rate hike from the Federal Reserve. This is why liquidity crises often appear to come out of nowhere. In reality, the stress has been building for months inside the Eurodollar system. The signals were there, but they were not visible to those watching only traditional indicators. Understanding the Eurodollar system changes how you read markets. It explains why global liquidity conditions can diverge sharply from domestic U.S. monetary policy. It explains why asset prices can fall even during periods of apparent monetary easing. And it explains why central banks are often reacting, not leading. Because when the offshore dollar system tightens, the Federal Reserve is forced to respond after the damage has already begun. This is why liquidity analysis must go deeper than rates, inflation, or currency indexes. To understand where risk assets are truly headed, you must track the plumbing of the dollar system itself, and that leads to the next layer of the system: the mechanisms that inject, drain, or redistribute dollar liquidity across global markets. That is where the illusion of easy money finally breaks. Part 3. Why dollar liquidity drives risk cycles. Every major risk-off event shares the same structural cause: a shortage of global dollar liquidity. When dollar funding tightens, borrowers struggle to refinance. Emerging markets feel pressure first. Volatility rises, risk assets sell off. This is not a temporary phenomenon. It is how the global financial system is designed. The modern market is built on leverage, cross-border funding, and continuous access to dollar liquidity. When that access weakens, the entire system begins to contract. Ironically, this is also why the dollar acts as a safe haven. During periods of stress, the world does not abandon the dollar. It demands more of it. Global debt remains denominated in dollars. Trade contracts are settled in dollars. Collateral in financial markets is still primarily dollar-based. Without sufficient dollar liquidity, the system cannot function. This is why risk-off cycles often feel violent and sudden. Once dollar funding stress crosses a certain threshold, markets are forced to deleverage. Positions are closed not because fundamentals change, but because liquidity disappears. This dynamic explains why asset correlations rise during crises. Stocks fall, bonds sell off. Crypto weakens, emerging market assets suffer simultaneously. The problem is not asset-specific risk. It is system-wide dollar scarcity. Risk-on cycles follow the same logic, but in reverse. When global dollar liquidity expands, funding becomes easier. Leverage increases, capital flows outward. Investors move from safety toward growth and risk. This is when equities rally, credit spreads tighten, and alternative assets outperform. Bitcoin and other digital assets thrive in these environments not because they are risk-free, but because liquidity is abundant. Understanding this cycle changes how you approach markets. Narratives become secondary. Headlines lose importance. What matters most is whether liquidity is being added or removed from the system. This is why markets can rise during economic weakness or fall during periods of strong data. Liquidity leads, fundamentals follow. What we are witnessing today is not the collapse of the dollar. It is a slow structural transition. More currency diversification, alternative settlement mechanisms, regional trade agreements. But none of these changes have replaced the core of the system. Global funding remains dollar-centric. Until global debt, trade, and collateral move away from the dollar at scale, dollar liquidity will continue to drive risk cycles. For investors and traders, the lesson is simple. Markets do not move on narratives, they move on liquidity. And global dollar liquidity remains the central force behind every major market cycle. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.